Hi, good afternoon, everybody. Thank you all for joining in on a Saturday afternoon. So today's topic is going to be what to expect in 2026. Okay, so we'll go through how Neo has done, how Neo is structured first, and then we'll take you through what's been happening and what the expectations are going forward for 2026. Now, 2025 was a really tough year, right, for the whole market, and the idea was that we would wanted to have some amount of uh, moderate expectations in terms of returns for equity. So there's a question: is this webinar only for Malaysia? Yeah, it's for Neo, which is part of our PMS suite, and it is meant only for non-resident Indians. But for information, you can look at it. This is again in line with our resident Indian PMS, which is Sphere. Right, so no issues. You can spend some time. Uh, I'll take you through if you have in the Q&A. I can take you through about Sphere as well. So and the difference between Sphere and Neo. So you can still hang on. The information is valid for both. Okay. So the idea was that we wanted to moderate our return expectations in equity, and our gold and silver allocations were on the higher part. And this year we expect that that should come off. So the expectation is that you definitely need to follow a multi-asset approach, but Neo has a very flexible mandate in terms of having a multi-asset approach. So debt allocations start to become a lot more higher now, and I'll take you through the chart so you'll be able to understand that as well. Our core focus themes have been majorly consumption, banking, and financial services, which is majorly large cap. So that is the approach that we will look to take even in 2026. Now, again, so what's been happening on the silver side? Silver has done phenomenally well this year, and Neo has benefited out of it as well, and so have all our investors. But going forward, do we feel that silver can still or gold can still deliver this sort of return? Probability is very, very low, right? Usually in these phases come and go. And silver, if you see over history, has had that phase multiple years. Gold has had that phase of negative drawdowns multiple years. And these are precious metals where the story of demand going up and prices should shoot up in relation to that. Again, this story is not right. There's no it works for some time, and then prices start going up very aggressively. Then naturally you start looking for alternatives and reduce usage of that particular metal in industrial uses, right? So again, that is a very, very big risk. The premium that we're paying in the smart spot market versus that of paper market is again very, very high. So again, two, three negatives are there. So some sort of a normalization has to take place. Now, this phase is for uh, another winner to arise out of. So silver has been a very good winner for 2025, but again, it has been a loser. So every time there is a different winner, every time there is a different loser. We think that next year going forward, the outlook for precious metals is more or less neutral. We do not expect very, very high returns to be made like what was made over the last 2 years, but tactical allocations towards precious metals is feasible. But having no allocation to precious metals also is very, very feasible, right? So that's the thought process that we go into 2026. Now, what has happened in terms of sectoral performance, right? If you see banking and financial services, auto, metals, all have done phenomenally well. What has been negative? Now, we have majorly a growing economy, 6%, 7% GDP growth rate, per capita income of north of $2,700. But yet you have a segment which is majorly on the consumption part that is not doing very, very well, right? So consumption becomes completely undervalued in India, and that is a segment that again is very, very cheap for us to look at in terms of India, because the growth is so high in India, uh, and projected growth also is expected to be strong. We are coming off slowdown, and this is a year that is poised to be a recovery year in terms of growth. So all the direct benefits and the indirect benefits that the government has given and the RBI has given definitely should lead into some sort of a recovery going forward. Now, that is extremely important for us to keep in mind, that undervalued parts of the market are more on the financial services part and on the consumption part. But what has done well up until now is majorly metals. And the consumption basket will have auto, it will have FMCG, it will have consumer durables. One thing is very certain, that we definitely need to still stay away from riskier parts of the market like small and mid caps. So small caps have had a bad run for the year. We expect that the next year also some opportunities can open up on the small and mid cap spaces, but broadly, as a entire segment, things stand to be a little bit on the uh, overvalue side and less attractive in terms of putting in more money. Now, what does it mean for having a multi-asset approach? Multi-asset approach is here to stay. If you see year over year, all the multi-asset approaches, be it 70-30, be it 60-40, be it having some allocation towards debt, some allocation towards precious metals, all have yielded into very solid results. This in turn has led to solid returns even for us on the Neo part, where we are having a flexible mandate. So what does Neo actually go and do? Right? Neo has a flexible mandate, which means no cap on any particular asset class. Right? So we can go from 0 to 100 in equity, we can go from 0 to 100 in debt, we can go from 0 to 100 in precious metals as well. All of it will be via precious metals, will be via ETFs, and whatever the most liquid asset class available to us within the precious metal part is where we will look to invest in. Right? The approach is going to be more top down and bottom up, which means that given top down opportunities, we look at two strategies, which is one active and then there is passive. And within the active, we definitely take a more direct stock exposure. But since it is a basket approach and since there is a lot of flexibility for us to invest even in equity, we can take an ETF approach to build a solid basket. For example, what we were able to do when we were very bullish on banks and financial services, particularly on public sector banks, we were able to, with the top-down approach and having a passive strategy, invest in a sectoral ETF for 1 year, 1.5 years. So which is a staggered approach in and a staggered approach out. Right. So we were able to build a basket of solid public sector bank businesses as well as private banks, so that we can create a very solid, high quality banking portfolio for you within our entire Neo strategy and Neo framework. Right. So here the multi-asset approach is here to stay, but having a more flexible mandate definitely works for investors, given that there might be years where there is no need for you to add precious metals. There might be years where you have to go a little lower on equity. There might be years where you need to have zero allocation to debt or slightly some allocation towards debt. So having that entry point and exit point and having a dynamic sort of strategy definitely works in investors' favor who are looking for a multi-asset approach rather than having a one-size-fit-all multi-asset approach model. Now, Neo can also invest in global asset classes. Now, what has happened in 2025 is that, going by global names, Korea has done very well, South Africa and Brazil have also done very well. But we at Neo have stuck to investing on the Chinese part, and that has benefited very well for us. So Neo can take a global exposure as well. Again, flexible, it can go from 0 to 100. Now, this again comes in our passive strategy for bottom up and top down. So the whole idea is that we would like to build versatile portfolios that prosper in all markets. So opportunities can arise in all markets, not only in India, but when we look to put money completely in India, we can take certain advantage outside of India, which is very, very cheap as well. Right. So it is a whole savings vehicle, just similar to that of 401k, that we look to do with Neo and Sphere both. Right. Coming back to India valuation seems to be a little bit on the fair side. So it's not very, very expensive and it's not very, very cheap. Right. So when we look at putting in money, we see it from a fair, cheap, very cheap, fair, expensive, very expensive. So today India hovers somewhere between the fair, slightly a little bit lower than the fair, but definitely not very, very cheap and not very, very expensive. Right. So going by sectoral weights and sectoral valuations, today financial services consumption again remain to be cheap. That is why this gives us that validation that definitely this is a cause for us to add more capital into these particular parts. So as of now, the whole basket of the equity will majorly be on financial services and consumption. However, given the growth and given the recovery that is lined up for India, expect that we would take some other sectors as well, which are core to economic activity and core to economic growth as well. So that is the expectation that we would like to set going forward. Slightly aggressive is what we would like to do, rather than managing a little bit more on the conservative part is what we've been doing over the last 3 years. Right now, in terms of earnings, again, earnings look very healthy for India, and the expectation also is that this recovery would lead into a good amount of uh, uh, valuation re-rating as well. So we are going with a very optimistic view of India, and we're going very, very optimistic view of the large caps, particularly that these segments would do phenomenally well for us going forward. Right, but always the horizon that we look for when it comes to investing in PMS products and particularly Neo is that you need to definitely invest for 5 to 7 years for you to see the full benefit of a strategy playing out, since it is a staggered approach in and a staggered approach out. So it takes us about 7 to 8 months to deploy our entire capital, and every portfolio that we build is completely unique and different since opportunities are evolving. It will be the same universe, but depending on your point of entry is where we would look to invest based on our particular universe. Right, so somebody who came in 1 year back versus somebody who starts in today, they would have a completely different portfolio. For example, they would not have any money going into precious metals at all. They would be replaced with other high conviction ideas into other asset classes. Right, so that's the whole idea that I'm looking to tell you. Now, how has this sort of approach done? Sorry, let me take you back into equity. So the consensus everywhere is that it's not very expensive and it's not very cheap. So we would definitely be very optimistic given that the recovery is on the cards, and India again becomes one of those top countries to invest in across the world. We have seen FPIs move out. We have seen a lot of support coming in from the DIA, and our expectation going forward is that India would again come into the limelight in the emerging market space. Maybe not immediately, but probably at the fag end of the year or the middle of the year, but definitely come up in terms of FII money. Right now, in terms of how we have fared compared to other strategies across the industry, if you compare us to another mutual fund of the same caliber, which is your ICICI multi-asset or your other categories, which is majorly on dynamic asset or flexi cap strategies, which are 100% on the equity part. So since our inception, we have fared very well, and over the last 3 years also, we've had healthy returns coming in. This return contribution has majorly come from our higher allocation that has been towards precious metals, and our expectation going forward is that we should look to do somewhere between inflation plus 5 to 7% higher than that. So always have that expectation when you're looking to invest in Neo. Given that this is a multi-asset strategy, we operate somewhere between a conservative and a moderate risk profile in the middle. We are neither conservative nor we moderate, but because of that flexibility, we can definitely amp up on our aggression levels when the markets are very, very favorable to us. Now, given that this is a multi-asset strategy, how are we able to manage drawdowns given our slight aggression when it comes to having some amount of volatility coming in from equity and precious metals? Neo has seen a drawdown, a maximum drawdown since inception of 10.7%. Nifty has seen a maximum drawdown of 16%. Multi-asset as a category is about minus 8.5%. Right, so we have little bit, since we are taking a little aggressive approach towards investing, our drawdowns are a little bit higher than the multi-asset category, but much lower than that of a 100% equity product like a Nifty 50. Right, so more or less risk-adjusted returns are on the higher part only. Now, coming to how Neo has been our asset allocation, this gives you a broad-based idea of the entire PMS, but today we are not looking to do anything on the, so every portfolio that we build is completely different. So portfolios that are being built now over the last couple of months have not had any allocation majorly towards precious metals, but we've had allocation higher towards equity, particularly consumption and financial services and so on. Right, our debt allocations also have gone up, but it has been at a pause since inception. This debt position that you're seeing has been zero, but today you see somewhere it is 5.5% or so. Right, so don't look at past returns to determine whether this is a good strategy to invest or not. Our idea is that we would like to set that expectation of average inflation plus 5 to 7%, and it is meant for those investors who are looking to build wealth in India, whose risk appetite is somewhere between conservative and moderate. Right, so India still stands to be very attractive in terms of 2026 and 2027 in terms of economic recovery, in terms of growth. Minimum investment to invest in Neo is 50 lakhs, similar to that of other PMSs. And there is a fixed fee structure of 1.5% per annum, which is computed on the daily average portfolio. So if 50 becomes 60 on the 60, right, which is charged to you quarterly. So 1.5% plus whatever is GST and all that gets charged to you on a quarterly basis, right? Per annum, quarterly charged, right? In terms of asset allocation, like I said, it can go from 0 to 100, completely flexible. Thank you all so much for joining in on a Saturday afternoon. Have a great weekend ahead. And again, wishing you all a very happy new year. For any queries, please do reach out to us on this number. And with all your queries, we can probably help you set up a one-on-one call with the strategist and with the fund management team and take things forward. Thank you all so much. Have a great weekend.